Hello, everyone. Welcome to another episode of Brick by Brick presented by Parvis. Today, we've got Jayson Zilkie from Northern Alliance Trust joining us. This is a really interesting episode. We recorded it late last week. Jason's in Guatemala at the moment, so we had some issues initially with connecting him to the webinar, but we're all good now. So Jayson shares a bunch of really interesting insights into what makes Northern Alliance special, a long track record, a really well-disciplined approach to their business model, which I think everyone who's looking at private investing should take a look at. As always, we've got a short disclaimer here. So the content that is shared in this webinar is not intended to provide and should not be relied on for investment, tax, legal, or accounting advice. A quick little something about who Parvis is. We're a technology-driven real estate investment platform, and we're a registered exempt market dealer in all provinces. What we're doing is bringing institutional quality real estate investments to eligible and accredited investors across the country. And we're looking to make that process as quick and easy as possible. Whereas in the past, there might have been a bunch of PDFs and an old way of doing things. We're really making this process simple and easy and putting people into these amazing products that they just don't have the opportunity to get otherwise. So you can visit us at parvisinvest.com. We'll include links in the show notes as always. Now we're going to cut to Jayson. So thanks very much for joining us and enjoy this one.
Well, hey, thanks a lot for having me today. I really appreciate your time. I'm looking forward to spending a few minutes with you all today. My name is Jayson Zilkie with Northern Alliance Trust and Shelter Lending. And we're exciting partner with Parvis. We've been partnered with Parvis since 2023. We've grown together, and we're loving to see the technology that they're using to help new investors come on and invest with us and other people. So we're very excited about our partnership with Parvis, and thanks for having us.
Yeah, absolutely. Good to have you here. It's really exciting to hear more about what you're doing and sharing that with our investors.
That's great. So just a little bit about me. Again, my name's Jayson. I'm from West Kelowna, British Columbia. I was a professional hockey player at one point in my life. I was a city council for a 4-year term from 2018 to 2022 in West Kelowna. I'm a registered mortgage broker, and I have my exempt market dealer license, and I'm a partner in our business. I have 3 children, 9, 8, and 5, and I've been married for about 15 years now. Yeah, that's a little bit of us. We're based in Kelowna, BC as our head office. We have team members in Calgary and Victoria, and we are Western Canada based. So this is where we know, this is where we're from, and this is where we lend. So here we go. So you can probably relate to these kind of investment issues, but our approach at Northern Alliance Trust is more like having customers join a family where failure is not an option. So we're a fund that's a product to solve a problem. So here's some quotes from our investors when they talk about historically predictable cash income. So I'm a private business owner, and I need to find a steady income stream for my retirement. I need more than a GIC can provide. So these are actual quotes from our investors. And, when you think about GICs, they probably average 2 to 3%. They're a little higher right now, but on average over the last 5 years, they've been, say, 3 or 4%, where we've averaged over 8% return. Capital preservation. Well, capital preservation is really the name of the game. So I don't want to watch my retirement capital drain out. I'll live off the abundance and not the capital. So we are very consistent. Capital preservation is vital at any stage of investment, and we help solve that, providing a consistent quarterly return every quarter since 2015, over 8%. You want to live free of the market jitters? Well, here's what a few people, our investors, are saying. I spend many hours analyzing stock trends. The market's unpredictable. I've lost confidence in my advisor. Sometimes I make money in the public markets, and sometimes I don't. Well, I think we can all relate to those statements and to money we have in the public markets. I wish I had no money, but I do, and unfortunately, it's very hard to get it out when it's so far down. But that's life, and you learn some good lessons and bad lessons. But I think we can all relate to things like this. So put capital to work outside of the public market, which is what we are. So I want to feel confident when I invest. I lost 8% overall in 2022, and I broke even in 2023. Well, what if I lose 40% of my capital in the next crash? So we're going to discuss how our fund is outside of the public market. It's safe, reliable investment, and you won't see those swings. Our greatest swing in 10 years was a return of only 7.5%. And that was our worst year in 10 years. So we've averaged over 8%, and I would call that consistency. So that's really what we're doing.
It's a really impressive track record to get those returns, and that lack of volatility in returns as well.
Yeah. And because we've been doing this for so long, so the people, our earliest investors have actually doubled their money. And that's super cool, and we're very proud of that. So how it all started, this is the founder's story, and really where it all began was what we learned in 2008, 2009 from the recession. So where our founders were managing a large fund in 2008, 2009, and it was a very big fund. It did all sorts of things. It did residential, it did commercial, it did development. It did really kind of any type of lending you can think of in the private lending world. And what happened was the market obviously crashed. So, when that happened, about 15% of the portfolio went into default. That means about 85% was still paying, but 15% was in default. And so when they analyzed the portfolio, what they realized was that it was actually a lot of these commercial properties, development, the raw land, high-rise hotels, construction. Those were the main properties that were at risk. The stuff where you can make a higher return, and the stuff that's more speculative, those were the items, the products, those were the ones that were in jeopardy. Most of the residential portfolio, in fact, the vast majority of it at that time, in a very difficult time in 08-09, were actually continued to pay, because people they didn't want to lose their home. But, whether it was a, construction or, some raw land deal, people walked away from those, and the fund never got their money back. So that's a great way to lose money. So when we started our fund in 2015, we took those very, very hard lessons that we learned from 08 and 09, and we said, hey, we're going to focus on one thing: residential mortgage lending. What we know, where we live, and that is just our strategy that we've done from the very, very beginning. You can call it very vanilla, but we lend in places where people live, in major cities, and we look for average price point homes. We don't want log cabins. We don't want, very unique properties. We don't want a $3 million house in Edmonton. We want average price point homes. And so that's what we do. And I'll get to kind of why we do that in a little bit more detail, a little bit, but this is the kind of the story, how it all started. And so we've really seen very few issues, because people who have residential homes, they want to keep that home. They don't want to lose the home. They don't want to have to foreclose on that. So that's really about how it all started and where we are today. So the solution to what the problem with investing is a private lending, mortgage funds, private lending. You have the opportunity to get higher returns, and the investments, they're secured against tangible assets that don't move. So why is real estate so important? Well, you can't take it away. It's not like a personal loan or a car loan. These are assets that cannot be moved. So if somebody stops paying, well, we have their home, and we can take that back and resell that property. And most of us have a mortgage, so we can understand, what lending is, because you have one, you've experienced one at some point, so you understand how mortgages work. So it is a bit easier to explain. So it's not something that's like cryptocurrency or something like that. It is simple, it's tangible, it is very, very easy to understand. And you don't want to put your retirement future capital risk, so you can understand real estate and mortgages. So we're here to talk about a solution that'll let you sleep at night. So income, it's historically stable. Our cash or in-kind dividends every quarter for the past 6 years, well, the past 10 years. We have two units. We have A and B, and you can see on this kind of graph here, the A units have paid 6.14 over 5 years compound and annualized, and our B units have paid 8.2% for the last 5 years. We'll go into a little bit more detail about A and B units in just a sec. But capital preservation, capital remains in the fund, and you can reinvest those dividends or enjoy the income. Majority of people, they actually reinvest, but we have many people, we have a lot of seniors in our fund, and they are living off those dividends every quarter. So it's certainly up to you, but many of our people are reinvesting those. So volatility, well, a lot of people are in A, and they don't want any volatility. They want to know exactly what they're going to get each quarter. So that's why we have two choices. 6.14 is for the A units, and then whatever is left over, 7.5 to 9% has been the range for the B units over the last 6 years. Safety, well, we're invested in Western Canadian residential real estate mortgages, and your involvement as an investor, well, there is none. So, it's a really set it and forget it. You watch it. There's nothing to analyze, nothing to do. We provide quarterly updates to our portfolio so you can understand what the return is and what our investment is. So we go over that with you every quarter. So the A units, as I discussed, well, they are basically paid first. So after quarterly financial analysis and profit determination, the A units get paid first. So, when we have, our fund, the profits at the end of each quarter, well, the A units get all those returns first. They're capped at 6% per quarter. So they don't have the same benefits of the upside, but they're getting paid first. So the risk is almost really next to nothing when it comes to the A units. So for people who are on, fixed income, or they really they don't want any volatility at all, they want to know exactly what they're going to get each quarter, they're relying that as income, the A units are a really good solid choice. Our B units, where most of our investors do have, this is really kind of analyzed. So for the last 5 years, the last 1 year it's 8.4%, the last 3 years 8.1, and the last 5 years is 8.2. So after all the A units get paid, whatever is left over, whether that's 7.5 as a low or 9% or higher, the B units are obviously getting the remainder. So there's no cap for B unit holders. So the sky, is the limit as high as the fund is able to produce. So that's the difference between A and B units. There is a slight risk of fluctuation, as we had 7.5 to 9%. But generally speaking, when you average that out over 1, 5, 10 years, it's been over 8%, and we don't see that changing anytime soon. In fact, we'll probably see an uptick trajectory in the next, 1 to 3 years.
I was just going to ask, have you seen a change in that given the high interest rates over the last year or two?
Yeah, we certainly have. I mean, when interest rates went up really quickly, it took us a while to kind of adjust to that. But, so you can see a slight dip when we had a 7.5, but now that the interest rates have been high for a while, it's really benefited us. So the rates that we're charging are much higher than we ever have before, because that's just the standard of what prime rate is at. So so our last quarter in 2023 was 9%, which was our highest dividend ever. So we think that the next quarter, in quarter one, is going to be 9% as well, and hopefully that trend will continue. And 9% is a really excellent sound round number. We like that. We're going to stick to that. So yes, we believe that it's going to be 9% again in quarter one of 2024, and hopefully the rest of the year.
Oh, it's really impressive thinking about how low rates were and the types of returns you were getting in that environment. And it gives, when I think about where rates might be in 2, 3, 4, 5 years, you've already got the track record of making great returns in a low rate environment and not relying on the higher rates. So from my point of view, that's a really great feature of, I guess, your history and your product.
Yeah, the rates, we aren't affected as much as the rates as some of the other producers that are small, that are much bigger than us, that rely on the bank. We rely heavily on our investors. Most of our fund is built up of people like myself and other people who invest with us. So we don't fluctuate with the bank and the prime, which is great. And so we know that if something happens with the bank rates, our returns are really going to stay the same. So we're not tied to the bank. So
it's really interesting. Thanks.
So here's a little bit about, our fund today. Well, we have over 50 million in assets under management, and you can kind of see how we started in 2015, and you can see the strong upward trajectory that we've built in the last kind of, especially, 3 or 4 years. But when you build trust over time, you do get momentum, and many of our investors have been with us for a long time, and now they're repeat investors. They're bringing all their portfolio, they're sharing with their family, their friends, they're comparing it against other funds. And when you have a track record of 10 years, well, I mean, it's there's a lot you can do with that. So we're growing, it's exciting, and it's a great time to jump on board. So here's a quote: so it's never a good time to take the money out of the public markets, but in Northern Alliance, it's always a good time to join. So we are happy to have you become one of our investors, and we have over 250 investors. We have over 250 mortgages as well, and growing. But we have everyone from, I have got my parents, my grandparents, I've got my siblings, my in-laws. So we're really we're happy to have anybody come into our fund, and we treat it like a family because as I'll talk about at the end, who's some of our investors. So maybe you aren't aware of kind of the overall mortgage lending space, or just in general. So in Canada, the banks hold about 72% of mortgages in Canada. Private lenders make only about 1% of the market share. So it's a really, I mean, it's a lot, but it's, as a percentage, it's really quite small. So the market is growing, and there's a lot of opportunity for us to kind of continue to grow. But overall, it's not the biggest market, and that's not the plan. It's not trying to be the highest, but what we want to share is that there is a lot of opportunity out there. So you can see that 52 billion is non-bank mortgage lenders in quarter three of 2022. That's a big number, even though it's only 1%. And estimated that the Alberta and BC and Ontario residential private lending is about 16 billion. So our $50 million piece or $100 million piece of the pie is really kind of almost insignificant. But so what that says is there's lots of opportunity to grow if it's 16 billion in BC, Alberta, and Ontario. So there's a lot of opportunity out there. Yeah. So private lending, and here's our formula. So you're wondering, well, how do we do it? Like, what does it look like? Well, this is kind of the secret sauce behind what we do. So you can see our logo, Shelter Lending. So Northern Alliance Trust is our fund. Shelter Lending is our management company. We're the same people, but we've separated out by a different brand. So the mortgage brokers in Canada understand who Shelter Lending is, and that's who we deal with predominantly. So we are lending where banks have said no to a client for various reasons. The banks might have said no due to their income, their credit issue, or their history, where the down payment is coming from, if it's borrowed or if it's a gift. They haven't had it in their account for long enough. The property type they might have, their location, if they have CRA tax issues, or how the funds will be used. Whether they're new to Canada, they're new on their job. There's hundreds of reasons. They're self-employed. When you're self-employed, it's very, very difficult to get a mortgage, even if you have good credit. So we see a ton of people who are self-employed who just don't have enough income on paper, and so it's really difficult for them to qualify. So where we lend, well, major centers in BC, Alberta, and Manitoba. So we're only in single family homes. If we do any acreages, they're really close to the city. They're small acreages. They're not farms. They're where people live. We do condos, townhomes. We do some multifamily where it's up to kind of 6 units. We do rental properties, and we do blanket mortgages. So if somebody has 2 properties and they want to borrow against 1 or 2 or 3 of those properties, we do that. But what's important is what we don't do. We don't do anything commercial. We don't do construction. We don't do farms. We don't do land development. We don't do raw land. And, when I talked about earlier, what we learned from, 08, 09 is that those may pay higher, and there's an opportunity to get a higher interest rate. But if something happens, if the market, changes or shifts, well, these are the ones where people walk away from first. So we aren't prepared to do any of those. We have a lot of opportunity to do it, but we've decided as a fund, as a fund manager, that we aren't going to be doing any of those things, regardless of if the opportunity exists or not. So we're happy that is the case. We're proud of that, and yeah.
Yeah,
So
I was just going to add,
yeah,
I always find that's a really it's a challenging thing to do as a business to stick to
yeah.
one thing that you know works when you see all of the opportunities. So I really commend you guys on doing that, to be frank.
Yeah. Some of that is PTSD from the recession in '08 and
Of
'09, and
course.
there was a lot of hard conversations that had to happen, and you had to tell, we had to tell the investors that, because we invested in some of these things, they're going sideways. Well, that's going to affect your return. And so we're not prepared to have those. We don't want to have those conversations with anybody. So we've just stayed away from that. So it's worked really well. We're very rigid in our guidelines when it comes to
That's
that.
fantastic.
So underwriting is basically every file or every application that comes to us, we review. So every application that comes to us, and I'm an investor, and we'll look through our management. We're all investors, so we're invested in our fund. So we look at every deal like, if this deal doesn't work for us, well, we could lose money. I could lose money, and I'm not prepared to do that. So we look at every application that comes into it. So last year in 2023, we had about 1,000. Well, we had about 1,000 applications submitted to our team, and we provided commitments on about half of those. So we sent them a letter saying, "Hey, yeah, this looks like something we could do," but only about 100 of those actually funded, because we saw something in the deal, the property, whatever it was. We said we only fund from about 10% of the applications that we receive. So we're very picky, we're very rigid. So what that looks like, so we had about $300 million worth of requests for mortgages in 2023. We issued commitment letters on about 100 million, and we funded 30 million of those. So yeah, again, we're funding about 10%. And so what do we look at? What do we look at first? Well, first we look at the location. Well, where is it? Is it in a city? Is it a good location? Is it a good part of the city? Whether it's whether it's Winnipeg or Vancouver or whatever it is, there's areas where we just don't lend. Regardless of where the city is, we just know the good areas and we know the bad areas, so we stay away from those. And the property type. Well, what is the property type? Is it a single family? Is it a normal, type of home? That's what we look for. The type of transaction. Well, why do they need the money? Is it a purchase? Great, we can understand that. It was equity takeout. Are they refinancing? Is it a spousal buyout? There's many reasons what it is. We just need to understand what that is. And why did they come to us? What happened? Did COVID happen? Was there a divorce? Was it an illness, an accident? What is the reason why they're coming to us? We have to understand that and be comfortable with that. And then we look at the loan to value and the loan amount. So we look for average price point homes. So when we see requests for $1.5 million purchase in Calgary, we just don't do that, no matter how low the loan amount is, because we look at how we do our business is that we look at every property as if they are not going to pay us, and we're going to have to sell that home and get our money back. So when we look at our whole portfolio, we are less than 65% loan to value. So for every $1 million, so if the house is worth $1 million, the maximum we will go is $650,000. So that means that the market would have to come down 35% before we lose money. So we assume that you aren't going to pay us. We're going to get our money back by selling your house. And we have to make sure there's enough and a buffer in that if the market goes down, or if we have to remediate that property for us to get our money back. So that obviously doesn't happen very often, but that's how we look at it. So we look at the property first, then we look at all the other stuff to the deal, whether it's the borrower's financial strength, the loan to value and loan amount, and then the valuation criteria. So every single file that we do, we have a third party appraiser review that property. So they do a full assessment of that property. It's paid by the borrower, and costs anywhere from $200 to $500. But they look at the property, and we get a full breakdown of every single room, every detail on that property, and we review that in depth. So we have trusted third party appraisers in every community that we lend in. So whether it's the Okanagan, whether it's Calgary, Edmonton, Winnipeg, wherever it might be, we don't, there's hundreds and hundreds of appraisers. We use 3 or 4 in every community that we lend in because we know them, we trust their work, and they are a really important part of our business. So the valuation of a home is super important. So we look at every single home that we lend on. We want to make sure that we know what it's worth, whether it's worth 100,000 or 500,000, whatever that is. We want to make sure we're comfortable with lending on that. And so that's why we only use specific third-party appraisers in every community. So yeah, that's basically in a nutshell how we underwrite. And yeah. And we want to make sure that there is, I'm not sure what that income, we want to make sure that they have a good exit strategy. Every one of our terms that we do is a 1-year plan. So we want to know, is that, is it a bridge loan, or, how long are they going to be with us? We do 1-year loans, but we know that the average time that people are with us is about 18 months. So we know that the 1-year mark, that hasn't always solved their problem. It takes longer than 1 year, but many people, it does take a year. So we want to understand, what is the exit plan? Is it, we just don't want people to be with us forever because it's not good for them, but also we want to always be having our money constantly moving and renewing over time. So, we want to understand that there's a plan to actually, whether it's sell the property, go back to your bank. We have, a purchase that, a refinance of a property, and they can go back to their bank in 6 months, because they have, they have enough time on their job. So there's various reasons why the exit strategy would be good, and that's very important of our whole scheme of what we do. So this is the mortgage fund business model. So this is kind of how it all works in a nutshell when you take a step back. So the investor capital is basically a big pool of money. That's the fund. We take that, and that goes into Northern Alliance Trust. And what we do is we lend that out on residential mortgages, as I've just discussed, how we lend, what we do. The gross yield on that is, roughly 10 to 12% in that kind of range. And then we have our fixed costs, our banking, administrative, our loss reserve costs. We have professional costs, and then the manager, Shelter Lending, takes a percentage of the fund. At the end of the day, we're returning 6% to our A units, and B, 9% or 8.2 in the last 5 years. So that's the return. So there's obviously a cost to actively manage, because we are actively managing the portfolio. We look at every new file. We're not absent managers. We are looking at every single file. We're keeping our portfolio up to date. We're adding new deals that we're comfortable with, and that's, so there's the cost to operate that, and you want your management company to have enough profit so that they're not taking anything out of the fund, and you're doing good deals. So we're happy with this model. It's been really effective. We've been doing it for 10 years, and it's been excellent. So as we grow, the nice thing about this is that our operational and management costs, well, they're actually going to go down, because the bigger we are, the less our professional costs are at scale, and the less our loss reserve costs are actually at scale. So the bigger we grow, our fees are going to come down, and at the end of the day, we're going to be able to return more back to our investors. So here's our leadership team. And so everybody you see here, we're all investors. Our family's investors, our friends are investors. This is how we started our fund, our company, and this is how we've grown today. So we did a quick analysis of the fund, of people that we know, our family, our friends, our very close network of people. Well, we make over 50% of the fund. So that's a lot of money. So we are so it's so vital that we make this a success, because everyone we know and all our family and friends are investors. So we have to make this a success. There's no preferential treatment to anyone. We're closely regulated by the Securities Commission. So we're all treated the same way. So just because I'm an investor or my family and friends are investors, doesn't mean we get any differential treatment or special rates. We're all the same. We're all treated as equal shareholders. But it's important to know that we are investors ourselves. So we are very highly motivated to make this grow, make this work, and continually increase our funds, because I have all my life savings in our fund, and as it grows, it's fantastic. And so I'm not prepared to take any type of loss. And so I am highly motivated to make sure we're doing things the right way. So raising capital. So we currently we have a minimum of $50,000 investment as of today. We're likely going to probably increase that to 100,000. It was 25,000. Now it's 50,000. We're raising 20 million. That's going to help us grow and get to a level where we can continue to put out really strong mortgages, and that is what we're trying to do. So we'd love to have you become an investor, and there we go. So we can sign up with Parvis. You can get set up today. We have a referral program. You can speak with Dave or myself. We are dealing representatives. We can talk about your information or talk about your investment. You can go through Parvis's platform. You can do it all online, or you can contact us directly and we can help you get set up. But Parvis has done a really good job of making it super easy to basically sign up fully digitally. You can get set up. We just review your investment. We make sure we understand what it is, and away you go. So yeah, we're happy to take any questions too now, if anyone wants to ask anything, or if you want to interject. But that's the end of my presentation today.
Awesome. That was really good, Jayson. I'd say, if I'm looking at the future, are you looking at expanding to other areas of Canada, or are you just looking to do more mortgages in the areas that you know already?
Yeah, so we know Western Canada so well, and there's really a massive opportunity. As I said, we had about $300 million worth of requests last year, and we only funded about 30 million of that. So we know there's a lot of opportunity to grow. Today we don't really have any plans to expand to Ontario. At some point we're going to go into Ontario as we kind of hit probably the $100 million mark. But today we see there's a ton of opportunity in Western Canada. And we don't really lend in Vancouver or like the Whistler Squamish area. So there's a big area where we don't lend just because the values are so high. But so there's other areas we could go to. But today we're super comfortable with what's happening in Alberta, in the Okanagan, on the island, in the Lower Mainland, excluding Vancouver. So we just haven't needed to expand beyond that. So Western Canada is where we know we're comfortable with. We think the market is really stable. And that's where we're planning to stay.
Awesome. Well, thanks again for coming and joining us here today. Like Jayson said, any questions, call that number there, email me. Jayson and Dave's emails are on here. Reach out through the platform on the website. There's plenty of ways to get in touch. So looking forward to working with you more, Jayson, and thanks again.
Okay. See you guys. Take care.
Right. Thank you. Bye.
Bye-bye.